So now we are on to class 6, principles of investing. We'll do what we did in the last class and do a quick review of what we've done so far. And I recommend you do this each class before the class starts. See if you can write out in outline form what we've talked about so far. Find some way to retain this information so it's still with you a month from now, 2 months from now. Many of you will be interviewing for jobs and internships, and again, this is an extremely common question in interviews. If someone came to you with $100,000, what would you do? And we're walking through the answer to that question so you can blow them away. But not just that, but this is extremely important for any of you who want to work in finance and investing, or even just figuring out what to do with your 401k plan when you get your first job. So we'll do that quick review, then we'll do an overview of stocks, and then we'll get into the details of stocks. Again, I have a mnemonic to help you remember the subcategories for the stock asset class. So quick review. Remember, we've defined what an investment portfolio is. It's a collection of assets. Assets includes things like stocks and bonds, but also real estate and commodities. But it's a collection of assets that someone is holding for some future purpose, some future liability, some future cash requirement. They need to ask 3 questions. Why am I investing? So what is that liability? Is it a retirement? Is it for education for you or for your kids in 10, 15, 20 years ago and from now? So what is the horizon? That's the why question. The what question is what asset classes? And that is what we're going through now, the different asset classes. Remember, there you want to be parsimonious. You want to make sure you have enough asset classes to explain your risk, but not any extra because of the hard work. The last question is how will you execute? Will you do it yourself? Will you hire someone outside? Will you try to beat the markets? Will you index? Will you be passive? Will you be tactical? Those questions on the how. We'll spend a whole lot more on the how question when we get into the second part of the class. Then we gave the 4 major asset classes: cash, fixed income, stocks, and alternatives. And we distinguish between cash and bonds. Cash and bonds are both the exact same thing. You're loaning money to someone, but with cash it's very short term, has a lot of reinvestment risk, but very low price risk. And then bonds are fixed income. Those are longer term, a year or longer, and they will have varying degrees of reinvestment risk and price risk. We talked about cash. Cash first, remember you define it. So cash is loans that are less than 1 year. You give the subcategories. There's no subcategories for cash. Cash is just cash. And then the strategy, all we do with cash is it's a holding place. It's where we move if we're very worried, or if we think there's some opportunities that may come, because cash is low risk from a standpoint of volatility of the price, but also very low expected returns. So it's usually an asset class most people don't allocate to. They just have it there just in case as an emergency. And then bonds, we talked about DC cuts I, duration, convexity, credit, U.S. versus non-U.S., which is really a currency play, taxes, structure, and inflation. And on each one of those, we defined it, we gave the subcategories, and we gave the strategy. So make sure for each one of those, for an example, for credit, we define it as the probability that you will be repaid, and it's also a bet on which sectors to be in. The subcategories were high quality, medium quality, and low quality. High quality would be like government bonds and AAA bonds. Medium quality be BBB bonds. Low quality would be below investment grade bonds and preferred stocks. And then the strategy is, if you expect a recession, move up in quality and move out in duration. If you expect a strong recovery, move down in quality, maybe buy high yield, and probably want to shorten duration. So that's it. You need to be able to do that with each one of those, the DC cuts I. Sometimes they're very easy, like inflation. Bonds are either nominal bonds where they have no inflation protection, or they're inflation protected bonds like TIPS. And so there's only 2 categories. So with taxes, structure, and inflation. There's only 2 categories. So hopefully this is starting to sink in, that you can talk through this intelligently and sound like you really know what you're talking about, even after just a few classes and from what we've been studying so far. So now we want to move to equities or stocks. So I'm on page 16 of the class notes. So I want to give an overview first. And this, you need to really understand stocks. So stocks represent ownership in a firm. You're a very small ownership. If you own a few shares of Apple, you're 0.0000001% owner. You're a very small owner. Apple is $1 trillion company. So if you only own $1,000 or $2,000 worth of Apple stock, you own very little, but you still are an owner of the firm. You have the right to vote for who management is. You get to vote on other decisions the firm makes when it comes before the stockholders. You are a residual owner. You have publicly traded shares. It's a publicly traded business, but in your residual owner, which means you get whatever's left over after they pay their bondholders and their other liabilities. You have unlimited upside, but limited downside. You can only lose 100%. So if you have $10,000 invested in Apple, the most you can lose is $10,000. Now you might see, well, obviously that's the way it always is, but that really is a very unique and recent construct, very unique to a very capitalist society like the U.S. So when you're a stockholder, you have limited liability. That is not always true. So you may have heard of a firm in the UK called Lloyd's of London. With Lloyd's of London, if that firm has trouble, they can go to their stockholders and owners and say, we need more money. You have to bail us out. So you have unlimited liability. You have the upside, but you also have the downside. If something goes wrong, they can actually demand that you give more money. So you can actually lose more than what you have invested. But with stocks in the U.S., the most you can lose is what you invest. That's a huge benefit to investors, and many believe it's the driver behind the wealth in the U.S., our innovation, our growth, the entire modern world. People can say, hey, I know the most I can lose is what I've invested in this firm. The bondholders, the other vendors, they take some of the risk. If this company goes under, the bondholders can't come to me as an owner and demand that I help bail out this company. So that's very important. Now, related to stocks is what kind of return can you expect from a stock? Now, when we looked at bonds, they're fixed income. So if a bond is paying 6%, then you're going to make 6% unless that bond goes in default. There's no uncertainty there except for the fact that there's some risk of default. But with stocks, what can your return be? So the return on stocks is whatever the current yield on the stock is, that's the dividend yield. That current dividend yield plus, and this is the most important thing, the expected return, expected earnings growth of that company. So if Walmart has a 2% dividend yield and we expect their earnings to grow 5%, then you take 2% plus 5%, you would expect to make 7% from Walmart. Now there's one last little piece in that, and that's repricing. We're ignoring repricing because it's very speculative. It all has to do with whether you think the stock market's overpriced or underpriced. Repricing long-term has added about 0.5% to returns over time, but that moves around a lot. When the stock market sells off 30-40%, that repricing over time shrinks. Right now, the repricing is really high because the stock market is up a bunch, even though earnings are not up a bunch. So we ignore that because it's just very speculative. So let's look at the next chart. Just let me prove this to you. I actually won't prove it very well. As you'll see in the next chart, we've actually moved somewhat away from that. But this is an important construct. From the stock market standpoint, the current dividend yield, which you can look up in Yahoo Finance, plus expected earnings growth is what a stock market should give you. And so just look at this historically. I love this chart. What I did, I wanted to check this and see if it's true. I went back to 1871. Anytime you see 1871, there's a very famous man called Robert Shiller. He's an actual Nobel Prize winner in economics. He's a professor in finance, a very popular professor now that he has a Nobel Prize. But he collected data on the S&P 500 back to 1871. Now, how in the world did he do that, given that the Standard & Poor's index, stock index, only existed since the 1950s or so? He went back and he tried to figure out what would the Standard & Poor's have done with their index if they'd gone back in time. 1871 seems really suspect to me. If you think about that time, the United States is recovering from some pretty bad economic times, coming out of a major civil war. We don't really have much of a stock market. We were probably an emerging, developing country at that time. We had some banks, some railroads, but I don't know what else you would have had that would have been major national companies, maybe some steamboat operators or something. I don't really know. I don't know where Thomas Edison was at this time, or Bell, probably a little early for them. So probably a pretty small stock market and probably pretty concentrated in a few industries. But still, he went back all the way to 1871 to try to reconstruct the stock market. You can get his data in Excel for free. You just do Robert Shiller data. Shiller is spelled Shiller. So Robert Shiller, and you just type the word data, DATA, and you can get this information. And it's really good information because it's not just the stock market. It includes dividends, it includes earnings, it includes the inflation rate. So if you need a long-term inflation rate, he has inflation, and he has a 10-year treasury yield all the way back to 1871. So it's a wealth of information. So what I did with this information is I did two things. The blue line is the actual return of the U.S. stock market. You can see it's done really well. $6 or $7 back in 1871. If you just stuck that $6 into the stock market, you'd have well over $1 million today. Now, realizing that $5 or $6 back in 1871 is probably worth, inflation adjusted several $1,000s a day, but the stock market had some really good returns. What I did with this red line is I took each decade, you notice it goes decade by decade. I took each decade's dividend yield and each decade's earnings growth, and I plotted that against the S&P 500 actual returns. And you can see all the way up to the sell-off in 2008, the stock market has tracked that line fairly well. Sometimes above it, you see the dot-com of the 2000s when the tech stocks got really expensive, but then the 2008 crisis brought us back down to the line. Now what you notice in the last 10 years, I updated this for earnings through the second quarter, and you can see because of COVID-19, earnings haven't grown very much at all this last decade, but the stock market continues to zoom up. We're getting close to new records. By the time you watch this video, we might have new records. So the stock market looks really, really expensive right now, mainly because the market thinks earnings were temporarily low because of COVID-19 and they'll jump back up. I don't quite have that view, but we'll see. So either earnings are going to recover very quickly or the stock market's really, really overpriced. And it's a pretty good debate between those two. If Biden wins in November, he will probably increase taxes on corporations, and that's going to definitely have a negative impact on earnings. If we don't get the vaccine for COVID-19 and we continue to see these 10% plus unemployment rates, that's going to have an impact. So I'm not quite as optimistic as the stock market. Plus the bond market right now with interest rates so low, the bond market's telling us that we have a major crisis on our hands, and the stock market's telling us, no, everything's fine. So something's got to give. One of those two groups is not correct. But I do love this chart. Up until 2008, it proves my point. After that, it either disproves my point or the stock market's really expensive right now. So what is expected earnings growth? Well, I'm going to argue, and you're going to use this very heavily in your paper 4, so make sure you've got this down. Not only do you need it for exam 1, but you also need this for paper 4. And I think it's really a good trick to keep at all times, is a basis for expected earnings growth, especially for the overall stock market. Might not work specifically for a particular company, at least in the short term, but over the long term, the expected return for the overall stock market and probably the overall expected earnings growth for individual stocks in the long term is going to be tied to the growth in the economy. And I'll say the U.S. economy. You could say the global economy if you have a global company like an Exxon or someone. But I'm going to focus on the U.S. economy. Corporate earnings growth have grown about in line with the U.S. economy, and actually a little more slowly. So this next chart will show you that. I love these charts. They take me forever to update because the data is a little bit cumbersome to get. If you're interested in how to get some of this data, the best way to do it is to type in what you're looking for. So here I did nominal GDP growth. You can just type in nominal GDP and the word Fed, F-E-D, and the Federal Reserve probably of St. Louis will come up. And you can click on that, and they have a way to dump all of this data into Excel very quickly. It's pretty amazing. So what I did here is I have corporate earnings growth and nominal GDP. Why nominal? Well, because I want to include inflation. Inflation is part of the growth in earnings. In fact, some people say stocks are a protection against inflation because corporate earnings can grow with inflation. They can, unlike a bond, if you buy, remember when we talked about the inflation risk for bonds, if you buy a nominal bond, that's a bond that just pays a fixed rate with no adjustment for inflation. If inflation jumps up, you're in trouble because if that bond's paying 4%, it's going to continue to pay you 4%, even after inflation kicks in. But stocks, they do give you some protection from inflation because when inflation's really high, corporate earnings should grow with inflation as corporations raise their prices. So I wanted to compare these two. I also put 5% in there. I consider 5% a good kind of benchmark for long-term growth, and we'll talk a little bit more about that. So I wanted to put that in there, and I also think you can see on this graph it's a good bottom part of the graph. And then I also put in the 10-year Treasury yield. The reason I did that is there's a famous professor retired from New York Stern School of Business, Dr. Damodaran, and he equates long-term growth of stocks with the 10-year Treasury. He says the two need to be together. Now, the class I watched of him, he was adamant that he would always believe that. He's actually been backing off of that recently, given that the 10-year Treasury is only 0.5%. Or below 1%. He's somewhat pulled back on that. But that was his long term. So I wanted to put that in there so you could see the long-term growth. And if you compare these numbers, corporate earnings, now I excluded this last COVID. So I'm doing the growth just before the COVID sell-off in earnings. And you can see it was right at 6%. Right above the 5%, but below the growth in our economy. So this green line is the growth in our economy. This red line, you notice, is much more volatile, is a growth in corporate earnings. And it makes somewhat of sense that our corporate earnings will grow more slowly than the economy. They should be somewhat in line, but a little slower. And part of that is this is the S&P 500, and a lot of the growth in our economy comes from companies that don't exist. That didn't exist in this index when it was calculated. Brand new companies that just started off, they're not publicly traded, they grow really, really fast, and then eventually they join the stock index, and this is just a stock index. So I've seen some reports that as much as half of the growth in U.S. corporate earnings, half of it comes from companies that are not in the overall stock index. But I do think this makes a case that whatever you assume for long-term corporate earnings should not be radically different than GDP growth, especially not radically higher. I think you can make a lot of theoretical arguments that should not be the case. It is somewhat in line with the 10-year Treasury, so you can see Dr. Damodaran over the long term has a strong argument. Where I have a problem today is to assume corporate earnings are going to grow 0.5% because that's where the 10-year Treasury is. So I think historically he's got a good point. I think right now I think it's a much weaker point, but I still like it on the graph. You can see my 5% is a good place where earnings in the sell-offs and recessions, they've tended to come down to that point. So that could be the case here with COVID-19, that we might hit this 5% line and bounce off of it. I can't tell you that's for sure going to tell you when the recession is going to end. You can see in 2008, it was much more radical, but a lot of that is financials. Financials were following an accounting practice called mark-to-market, where they were marking their bonds and other assets to market price. In 2008, they had to write them down, and in 2009, they wrote them back up. So that was a very temporary thing. You did not have that in prior accounting cycles because we did not have fair value accounting back then. So this is a very unique to 2008. It will affect 2020. However, while banks are struggling somewhat, it's not as big of a crisis as in 2008. So I don't think you'll see as much of that mark-to-market risk that you saw in 2008 to really drive earnings down. So historically, stocks have had a dividend yield about 4%. The dividend yield today is only about 2%. A dividend yield is just the current dividend stocks are paying divided by their current price. And I'll show you when you do paper 3 and 4, I'll show you where to get that number. And earnings growth historically has been about 6%. So stocks have historically made about a 10% return. There's that 6% I just showed you on the previous chart. But today, dividend yields are much lower, and I don't think earnings growth will be as fast going forward. And that's because I don't think economic growth will be as fast as going forward. And so here's economic growth to the U.S. Now you see how you have to fit all this together. Think back to what we said. Number one, get this in your notes. This is so important. Make some kind of schematic. Number one, stocks give you an expected return of dividend yields plus expected earnings growth. Number two, expected earnings growth on stocks should be closely related to economic growth in the United States. And here's number three, economic growth in the United States is driven by three things: productivity growth, labor growth, and inflation. And that's why we keep saying nominal. We want to use nominal, we want inflation in there. I'm going to say that's going to be somewhere in the 4 to 6% range. 2% productivity, 0 to 1% labor growth, and 2% inflation. Maybe productivity could be 3%. Maybe labor growth could be 0%, maybe 1%. I don't see labor growth much more than 1%. And I think 2% inflation makes a lot of sense because the Fed keeps saying that number as their target, or at least some benchmark that they're using. Productivity is a function of a nation's innovation, its education, its immigration, government regulations. We're going to talk about this, ease of doing business, and there's some cultural aspects. I think the U.S. still has a huge advantage on innovation. I've seen other countries like Russia and China trying to set up their own Silicon Valleys, but really struggling to do it. Why? Because of government regulations. I think U.S. has an advantage in education in some areas. I think our public schools are a disadvantage, and I'll show you that later. On education, we look at around the world, and we'll see what other countries are doing. I think the U.S. has a huge advantage of immigration. I know it's a huge debate right now. I'm very much on the pro-immigration side. That makes some of you really angry with me. I think U.S. has benefited. In fact, the data I think is overwhelming that we've benefited dramatically from immigration. Definitely, we've benefited from legal immigration, given that over half the companies started in the United States have been started by people who were not born in the United States. I think even undocumented workers show a huge advantage to the United States, and other countries like Japan and China, and there's a lot of countries. The immigration is very restricted and is really, in fact, Europe right now is going through some of that. You see Merkel in Germany in a lot of trouble because of how free she was in immigration, and there's been a backlash on that. But that's a big part of it. Government regulations. I don't know if you've ever seen, there's a group called the Institute of Justice, IJ. They have a lot of YouTube videos. I encourage you to watch them so you can see how the U.S. government has really been increasing regulation and made it much more difficult to do business in the United States. They have a lot of examples, and just a simple example is someone wants to do a food truck in a city in Kansas. And Kansas, because existing restaurant owners do not want competition, they put huge regulations on food trucks. Not to protect the public. These aren't food trucks that are violating food safety standards or anything else. They simply want to do business like any other restaurant. And there's regulations that say they can't open up their stores within, say, 150 yards or feet or whatever of an existing restaurant. The only reason for those regulations is to clamp down on competition from existing businesses. And you can see that a lot in the U.S. I encourage you to watch their YouTubes to get you fired up that we need to fix some of these things. There's other things related to that that really cause trouble in the United States. I think we've really gone overboard. Um, Unfortunately, our November election, both candidates, both Trump and Biden, are big fans of things like these regulations, like eminent domain, like asset forfeiture, things that really make the U.S. less competitive. But I think Europe has a lot of regulations as well. We'll talk about that more when we talk about the U.S. versus the non-U.S. But it's a big issue. It's something you want to watch in the U.S. And in cultural, the U.S. still has a culture that it's okay to fail. It's okay to start a business and fail. Some cultures, you hear this a lot when you read the history of Japan, that starting a business and failing is just not culturally accepted. And there's been some work, I know, with Abe, the current leader of Japan, to change that culture. And you certainly see some really great companies in Japan. And so there has been some shift there, but there's still some cultural issues around the world. So that's what we can look at. Is productivity is, I think, the most important part of this equation. So let's look at some history here. I love this chart. You should definitely put this chart into your paper 4, maybe even paper 3. But what this chart does is give you the history by decade of those 3 components. Productivity, the blue, labor growth, the red, and inflation, the purple. And one thing you'll notice on productivity, it's the best productivity the U.S. has ever had was in the 60s, close to 3%. In the 2000s, we had a recovery in productivity about 2.5%, but you can see most years we've been right at 2% or lower. And the last several years, this last decade, 2010 through 2020, is our worst productivity ever. In fact, President Obama, when he was leaving office, he wrote an article in The Economist, a very interesting article. And the one thing he said that he worried the most about, you could think of all kinds of things he would say, but he said his #1 issue was the weak productivity in the U.S. And it's not just in the U.S. You see this around the world. It seems amazing to a lot of people given what's going on with the Internet of Things, with broadband, with working from home, online, Zoom, autonomous vehicles may be coming along, solar energy, electric vehicles, all this stuff that we're seeing, 5G, you just name it. Why isn't that productivity shown up in our numbers? And there's been a lot of questions. Some people actually think the productivity number may be wrong, may be in error. But who knows? I think COVID-19 may actually kick productivity higher. I love it that my last doctor visit was a Zoom meeting. That made me so much more productive. I could stay home and do much more things and not spend an hour driving to the doctor's office, sitting in the waiting room. I've sat in doctor's waiting rooms for over 5 hours. Doing it by Zoom, they had to be there at the scheduled time. They had any choice. So efficient. A lot of meetings I used to drive 30 minutes to go to and then sit in them. Now we Zoom them, so there's no drive time. So I love it. So maybe we'll start seeing some of these numbers. I think autonomous vehicles, I know Tesla's talking about a 1,000,000-mile battery. So I think electronic vehicles, especially when you start getting autonomous vehicles, they last a lot longer. They're much more efficient. So, you see those kind of things. But I still think you're in the 2 to 3% range on productivity. And some people think if productivity really does well, that it's really going to harm labor growth. Labor growth is very dependent in the United States on immigration and immigration policies. At the time I'm doing this video, President Trump has really clamped down on some of the immigration, even for high-skilled workers, and he's using COVID-19 as the argument. And you're seeing firms like Google and Amazon complaining that they cannot get high-skilled labor because of that. Those firms really like immigration and they need a global workforce. So, there's a lot of issues here. In paper 4, in papers 3 and 4, you will have to deal with this. What do you think long-term growth of the U.S. economy and the corporate earnings would be? Labor growth, if you look at it, it's been about 1% historically, But in the 2000, from 2000 to 2010, we actually had negative labor growth. And that's because we built up so much in home construction and in banking. Those industries got way too large. And in the 2008 crisis, a lot of those people got fired. We've had really good labor growth since that time. Now this, I think this does include COVID-19 impacts. I'll have to go back and look. Obviously, COVID-19 had a huge impact on this. It says through Q2, so I can't remember how much labor data I had in there. So even with COVID-19, I know I went through as far as I could. I think I got as much data as I could. I think that reflects it because we do have the June employment report out. So even with that, we're still doing pretty well. And inflation is whatever inflation is. Obviously, in the 70s, we had really high inflation. But the Fed's arguing for 2%. You can notice historically, like I told you, our economy's grown about 6%. The chart I show is a little bit more than that, but that included exports and imports and some other adjustments. But for the most part, our economy has historically grown about 6%. The question you got to ask is, what do you expect going forward? And so if you look at this chart, I say 2% plus 1% for 2%. I could see 2% plus 0 plus 2%. That gives you 4%. I could see 3% plus 1% plus 2. That'd be the higher end to give you 6. I really think anything in the 4 to 6% would be great. Now you're seeing reported numbers of like 2.5%, 3%. That's real GDP. That excludes inflation. So my real GDP number is about 3%, maybe somewhere between 2 and 4. We've had a tough time hitting just 3%. And I don't know if you noticed the last GDP number that came out for the second quarter, the first reported number was negative 34%. So obviously that's going to have an impact. And you saw that in my chart here where GDP really dropped off and corporate earnings really dropped off. So you've got to decide what those numbers are. And in paper 3 and 4, you can't just copy me. You've got to come up with your own assumptions. It's fine if your assumptions are close to mine. I think they should be in that 4 to 6% range. If you use something smaller than that or something higher than that, you'll definitely have to justify it. But I think this chart's a really good chart to help you do that. All right, I'm about halfway through the class. So I want to start on the BUCS of stocks, the BUCS. So if you want to hit pause and go get something to drink or something to eat, this would be a good time to do it and maybe think back through that introduction to stocks that we just talked about. All right, so let's talk about the BUCS of stocks. The BUCS of stocks is beta. Then I'm going to shift over to the C, which is capitalization, then style, and then just like we have with fixed income, U.S. versus non-U.S. Some students get very confused on the U.S. versus non-U.S. and on an exam, they only talk about it related to one or the other, but you need to talk about that in both with stocks and bonds. Remember with bonds, U.S. versus non-U.S., we said that tends to be an alternative asset class because of the currency risk. With stocks, that's not the case. It really is a sub-asset class. So let's start with B, beta. I use the word beta. It talks about the overall stock market, your exposure. So really we're talking about, do you want to be in stocks or in bonds? Stocks are risky. High quality bonds are low risk. So if you're expecting a recession, you definitely want to increase high quality bonds and reduce your stock allocation. But beta also tells you what industries or sectors you want to overweight or underweight. Now the word beta comes up in the capital asset pricing model. Hopefully you remember that model. If not, we'll cover it again later. I'm not using beta in the same sense here, but somewhat I am. So you'll see when we talk about beta, we're talking about do you want to be in stocks or bonds, but we're also talking about beta in terms of what sectors. And you might remember from your previous investment class or previous finance class, when you're talking about the capital asset pricing model, there are some stocks that have high betas and some stocks that have low betas. So it's real clear right here. Sometimes with beta, we're talking about do you want to be in stocks or do you want to reduce stocks because you're expecting a recession. Here we're going to ask, what sectors do you want to be in? If you're expecting a strong economy, you want to be in high beta stocks. Stocks that have betas greater than 1. These are what we call cyclical stocks. Make sure the word cyclical is in your answer when you talk about beta and the B of BUCS. Cyclical stocks are like retail stocks like Nordstrom's or Macy's or Tiffany's. It's durable goods like cars, heavy equipment, planes. It's commodities and materials that are part of production. So I'm not talking about gold here. Gold is really not a cyclical stock. It's really a defensive stock. But commodities like steel and concrete, they're part of construction. Commodities, metals, industrial companies, those are type that are they're part of the manufacturing side of the economy. Those are high beta. Travel and leisure, that's a consumer discretionary. Those are going to have high betas. Then you have defensive stocks. They have low betas. These do well during a recession. Cyclical stocks do badly in a recession. Defensive stocks do well. They hold their own in a recession. They have low betas like department stores, like Walmart, Costco, Family Dollar. Gasoline, we tend to buy gasoline, maybe not as much in a recession because maybe people lose their jobs and they don't drive as much to work, but still gasoline tends to hold up in a recession. We buy food in a recession, so grocery stores do really well in a recession. So these are all consumer staples. Utilities do well. Telecom does well in a recession. We tend to keep our phones. We tend to pay our electric bills. Healthcare, if we break our legs, we're going to go to the doctor and get it fixed no matter what the economy is doing. Healthcare can be a little bit hit by economy because if people lose their jobs, they may lose their health insurance. But for the most part, healthcare does okay during a recession. We saw that with COVID-19. In this last recession, healthcare obviously did well because it was on the growth side of that particular crisis. And in some, we're kind of in between. Technology is generally thought of as a greater than one, but people are talking more and more about Google and Apple and even Facebook, maybe Facebook not as much, but Google and Apple being more staples. I think even maybe Facebook, because let's take advertising. Firms now with advertising, they think with advertising they have to do Facebook, they have to do Google. If they're going to cut back on advertising, it might be on TV networks or in magazines. But Google and Facebook, they have to do the advertising because that's where you get the most eyeballs. And so people talk more about firms like Apple and Google and Facebook being almost more like utilities. And there's even some regulators that say they want to regulate Facebook like a utility. So maybe they're becoming more. Obviously, this last recession with COVID-19, those huge tech firms did extremely well. Their stock prices are at all-time highs. So you certainly argue that they were defensive stocks this last recession. Here's a chart that shows you the general thought. Here's the different sectors in the S&P 500. You can see the largest one right now is technology at 27%. It's actually much larger than that, but they broke out a new section called communication services, and that's where they stuck Google and Facebook. If they had not done that, information tech would have been well over 30%. I can tell you historically, when a sector goes over 30% of the stock market, it usually crashes dramatically. Energy went over 30% in the 70s, and then it crashed. Financials went over 30%, and then they crashed. Information technology went over 30% back in the late 90s, and then they crashed during the dot-com. It may be different this time. I saw a really good blog or a really good podcast that was talking about how going forward, every company is going to be a technology company. Every company is going to be a software company. It's just technology has so taken over every industry. Healthcare. I just mentioned healthcare. Healthcare is going to become more of a technology industry. Communication services. Firms like Facebook and Google and Disney, they're becoming technology companies. Energy is becoming more technology material. Everyone's moving more and more stuff to technology with robotics and artificial intelligence. So maybe technology shouldn't be its own sector. Maybe it should be broken out in these other groups. But you can see what I have for low to medium betas, high betas for materials and industrials, low betas for staples. This could really help you when you get to paper 4 and you have to pick a beta for the company you're going to value. So anyway, that's just my opinion. What about the tactical move with beta? Very, very easy. If you're worried about a recession, you need to reduce your stock allocation and move to high quality bonds, and then reduce the beta of your portfolio. The way you do that is you sell your cyclical stocks and you buy your defensive stocks. Very, very, very important. If you're worried about a recession in the future, if we're in a recession right now, it's too late. So this is a forecast. If you're forecasting a recession, then you want to reduce your stock allocation and move to lower beta stocks. If you're in the middle of recession, it's probably too late, and then you might want to be buying stocks. I was buying stocks dramatically in March and April when the stock market sold off and we went into the recession. But if I knew the recession was coming, say in January, February, I would have been selling stocks at that point. All right, so that's beta. Just to show you how different sectors have done the last 10 years, energy stocks have actually lost money the last 10 years. And this year, they're down 36%. This is through August 5th. The last year, they're down a third. Financials are down a bunch. Now remember, financials did great right after the election of Trump. It was really surprising. A lot of people thought when Trump would won the election, the stock market was going to sell off. And it did for the first couple of hours overnight, but then it took off. And financials especially had huge returns. But financials, the last year or so, have really been struggling. Right now, a lot of people are worried about financials for two reasons. First, there's a lot of consumer discretionary and energy companies are going insolvent. And because of that, banks are seeing large bankruptcy losses on their balance sheets. And the second thing that's killing banks is the low interest rates. Banks do not like low interest rates because what happens is there's a minimum to what they can pay on savings and checking accounts and CDs. Zero is the lowest they can pay. And yet auto loans and credit card loan rates, they keep coming down. And so margins for banks are being compressed and it's really hurting them. They've done okay. The last 10 years is not great. They're one of the lowest returning sectors, but at least it's positive, whereas energy has actually lost money. And obviously technology has been the place to be. They're up 45% this last year. They're up 24% here. It's interesting, tech utilities are down. I can't really explain that. That's kind of bizarre. The last 10 years, tech is what's done the best. And interesting to me is consumer stocks, consumer discretionary and staples. They've actually done pretty well, even though we've seen a lot of consumer discretionary companies like JCPenney and Sears, Kmart. There's a bunch of them that are going under. Macy's that is struggling. Still, for the most part, this consumer discretionary has done well. And Amazon might be in there, and that might be a driving force behind that. But picking the sector is really, really important. You can see how important it is. Most people say just stay diversified. Some people say when one sector becomes a big part of the industry, like right now technology, you should get a little bit worried about that sector. But still, it is what it is right now. You have to make a decision: is technology going to continue to do well, or is it really getting overpriced? I will tell you one big difference between technology today and what we saw in 1999 is technology industry today has huge earnings backing it up. In 1999, the stock market was going up for tech stocks without any earnings. People were buying anything that had the word .com in the name, and even though they had never made any profits. So we don't have that today. These companies like Facebook and Google and Apple, they're making a tremendous amount of money. All right, let's go to the next one, capitalization. Capitalization is essentially the size of the company. It's the market value of the company looking at its current stock price. And what we do here, so that's the definition. We're back to the definition. I gave you the definition on beta. I gave you the classifications, cyclical and defensive stocks, and I gave you the strategy. The same thing here on capitalization. We break stocks into large cap, medium cap, small cap, and micro cap, and even penny stocks. Large cap, these numbers are very, very kind of moving all the time because the stock market is moving all the time. But large cap, I say $20 billion or higher, that's large cap. Now, Apple is a $1 trillion company. We've got Amazon and Google and Microsoft all in that several $100 billion, if not getting right at $1 trillion. So huge companies. So 20 billion doesn't sound all that large anymore. Mid cap is probably 2 billion. I say 1 billion here, but 1 billion to 25 billion, maybe larger, maybe smaller. Small cap, 100 million up to 2 billion, could be a little bit larger than that. And in micro cap, less than 100 million, you're getting into pretty small companies. And in penny stocks. Now, penny stocks are essentially companies that are insolvent, but their stock is still trading and will trade until they just shut it down. So GM, before they went bankrupt, or when they went bankrupt, their stock kept trading. Now they've issued new stock since then, but that original stock, it traded as a penny stock, and it fluctuated around 50 to 100% every day, just all over the place. 20 cents, 40 cents, 90 cents. We saw here just just this summer, Kodak stock. Kodak is bankrupt. Kodak is nothing more than a company paying its pension plans. But President Trump said he was going to use Kodak to produce the chemicals for the vaccine, and suddenly that stock went up 20,000% overnight. Pretty amazing. I've never seen anything like that before. So you can make a lot of money on penny stocks. Most of the time, you just lose 100%. I'm going to ignore penny stocks and micro cap stocks, because that's really for those who are not faint of heart. They're very risky. I know some people buy penny stocks, really don't know what they're doing, and they lose a lot of money. So I'm going to stay out of those. Small cap stocks are very legitimate, very much their own asset class. I love small cap stock. It's a really good asset class. These different sectors, large caps, medium, and small cap, tend to be highly correlated to each other. So there's not a lot of diversification benefits. So it really comes down to the risk return. Large cap are risky, but they're not as risky as small cap. Large cap have high expected returns, but not as high as small cap. I have some students who say large cap have low expected returns and low risk. That's not true. I'm talking about relative to small cap. Relative to small cap, large cap have lower expected returns and lower expected risk. They're riskier than bonds, but less risky than small cap. They have a higher expected return than bonds, but they have a lower expected return than small cap. Why? Because small caps have a higher expected growth in earnings. So, and it's pretty basic and straightforward. When you expect a recession, you want to get out of small cap and move to large cap. Large cap do better in weak economies, mainly because a lot of small cap companies go insolvent. They just cannot get access to the capital markets, and they go under. So if you look historically, large cap has recently done well. If you look back over a longer period of time, I can't give you a longer period, but over 5 or 10 years, mid cap, especially the last 10 years, mid cap has done exceptionally well. Large cap's doing well right now because of what's going on with Facebook and Google and Amazon and Apple. Those huge companies are just really driving the market up. You can see it's a big difference, 17% versus 35% return. But if you look at mid-cap longer term, mid-cap is just off the charts. They've done extremely well. I don't know why mid-cap has done so much better than small cap, but if you go longer term, mid-cap's the best, then small cap, then large cap. But here recently, because of what's happening to those huge tech companies, large cap has taken off and done extremely well. The next one is the S, and that's style. Style is something you may not have heard before, and this is a little tricky for some students. They don't do very good jobs, so take some good notes here on growth versus value. Growth stocks are essentially companies whose earnings are expected to grow really fast. Value stocks are companies whose stocks are really cheap. And they're cheap because they are low quality. That's extremely important to get into your notes. Value stocks are cheap because they are low quality. Macy's stock right now is trading incredibly cheap, like at a PE ratio. I haven't looked at it recently, but a PE ratio probably of 5 or so. That is a very low PE ratio. That's a very cheap stock, but it's because people think Macy's, because they're mainly in malls, and malls are doing extremely poorly right now, especially with COVID-19, more and more online buying, especially with clothes. People are getting more comfortable buying clothes online, especially this new software where you can actually see yourself in the clothes online. Pretty amazing stuff. That has really harmed some of these firms. Now, Nordstrom's has done better because they have a few other bells and whistles that are working in their favor. But still, it's been a tough time for some of these big box stores. That's a value stock. Remember that the value stocks are low quality, and that will help you understand when to buy a value stock and when to buy growth stocks. Growth stocks do a whole lot better in recessions, and value stocks do a whole lot better in strong growth economies. Now, recently, I know it doesn't matter because the only thing that's done recently has been growth stocks because of the big tech companies. But over the long term, growth stocks do much better in recessions, and value stocks do better in strong economies. They're cheap stocks, but they're also low quality. But if the economy does well because they're cheap, you're buying a very inexpensive stock, and that's just going to increase your return. So growth stocks have high expected future growth and earnings, but they also tend to be very expensive. They have high price to earnings ratios. We'll talk about PE ratios later in this class. Value stocks have low expected returns, and in fact, they may even be at risk going insolvent. And so they're very cheap. They have low price to earnings ratios. Because growth stocks tend to be much safer and stronger companies, they do better in weaker economies. We definitely saw that this summer. And value stocks, they tend to do better in stronger economies. Just looking at the numbers, there's no question growth stocks the last couple of years have just materially outperformed value stocks. 71% return versus an 8% return. It's just not even close. And you can see really with COVID-19, they both sold off with COVID-19, but tech stocks have really come back since April, very, very strong, whereas value stocks are still well below their peak. They were up, a good 25% when tech stocks were at 50%. They're only up 7%. They've lost, over half of what their gain, almost 2/3 of their gain they had going into that. So that's style. So what's a growth stock? A growth stock is a Google. Oftentimes they don't pay dividends. A Google and Amazon. What's a value stock? Walmart, Campbell's Soup, Macy's. And the world is shifting somewhat. There was a time not too long ago that Apple, several years ago, Apple was actually a value stock there for a while. It can move over time and just depends on where a firm is on their growth story. There have been firms like Microsoft and Apple that have reinvented themselves and gone from being a value stock to being a growth stock. So it can change over time. I've seen some debate about Google and what exactly is Google going to do because their main core business is really not growing all that fast. The advertising, just because they've so saturated the market. You might see the same thing with Facebook. The advantage Facebook has is they're still adding new Facebook clients. So, you have to ask some of these companies, they're so huge, like an Apple, they're so huge, to keep growing really fast is very difficult for a huge company. For a $1 trillion company, it's going to be hard for them to grow their earnings 15-20%. It's just going to be almost impossible. You see firms like Intel and prior high growth companies, they just can't maintain that high growth. Tesla would probably be considered a high growth firm right now that they have earnings. So their style. All right, so I want to get started on this last group, the U of BUCS, U.S. versus non-U.S. I recommend you don't do in the order of BUCS. I would do BCSU, just have BUCS so you can remember the four of them, but put the U last. The reason for that is beta, capitalization, and style are all U.S. related issues. Now you can also do them overseas, but when you talk about cyclical and defensive stocks, most people are talking about their U.S. portfolio. There are people, and we'll talk about this later, to talk about large cap and small cap for non-U.S. stocks and growth and value for non-U.S. stocks. You can definitely do it, and the analysis is exactly the same. But when I'm talking about beta, capitalization, and style, I'm talking about your U.S. stocks, and then U is talking about your non-U.S. stocks. So again, the definition here is pretty straightforward. The definitions, we're talking about stocks that are domiciled outside of the U.S. So let's get right to the definitions. So right up front, let me give you a real quick definition. When you see the word global stocks, what that means in the industry is that you have a stock portfolio that includes both U.S. and non-U.S. stocks. When you see the word international stocks mean a portfolio of stocks that do not include U.S. stocks. So global is U.S. plus international. International is just non-U.S. stocks. So the global stock market can be broken out into U.S. and then you can put a sign over here. Mark these next three. These are international stocks. So all three of these are international stocks. So we have U.S. stocks, international stocks. We break international stocks into developed market, emerging or developing markets. Sometimes I say developing, ing, or emerging market stocks. And then frontier market stocks. I won't talk much about frontier market stocks. They're pretty risky. We've already talked about U.S. stocks. We talked about beta, capitalization, and style. Developed markets are those large, more stable countries like the UK and France and Australia and Japan. Israel's in there, so more stable market. And I'll show you what I mean by stable here in just a second. What the definition? There's a precise definition. It's not like a subjective thing. They have similar returns to the U.S. large company stocks, but they do provide diversification. First, from currency. So here's the place. Remember when we talk about non-U.S. bonds, most people avoid them because currency risk takes over and become very volatile. But with stocks, currency actually helps diversify your portfolio. So if you're worried about the U.S. dollar weakening, which it has here recently weakened, it was real strong there for a while, and it recently, just in the last few weeks, has weakened. You're worried about currencies. Investing overseas can help you protect you from a weak U.S. dollar. But you also have economies. Economies don't all fall in recession at the same time. Now, obviously, this last summer, we saw most of the world falling into recession because of COVID-19, but they don't always have the same cycles. So you can have different economies moving at different times. So you get somewhat of a double diversification benefit with non-U.S. stocks, developed market stocks. Emerging market stocks these are emerging countries like China, like Brazil, like Mexico, like South Africa. They're growing fast. They're developing. They're not developed yet. They have high expected returns, although you can question that on especially developed and developing, mainly coming from their higher expected economic growth, but they definitely have much higher risk. They give you some diversification benefit, not as much as we've seen in the past. And sometimes emerging market stocks can be very highly tied to the U.S. market. When the U.S. dollar strengthens or weakens, it can have a huge impact on emerging markets. Also, a lot of emerging countries, you think China sells a lot in the United States, but you also have a lot of emerging countries that do heavy commodities. And because they're heavy in commodities, there's some countries that are heavy into concrete, or steel, like China is a heavy steel producer. When the U.S. goes in recession, those markets are going to really sell off and be, if the U.S. sells off 20%, they'll probably sell off 30%. So you're really getting much less diversification benefit in the past. And a lot of them currency-wise, a lot of these countries, their currencies are actually pegged to U.S. dollars, so you don't get as much as the currency. So when I talk about currency diversification, I really strongly tie it more to developed markets to developing markets. It tends to be more of a mixed bag with developing markets. Frontier markets, boy, that's if you've got some guts. I saw an investor who had started a hedge fund where he was investing heavily in Iraq when Iraq news was terrible. There was this really terrible news, but he went to Iraq and he said, yeah, it's bad, but it's not nearly as bad as the news in the U.S., and there are some really good operating firms, and he really did well. I don't know how he's done recently with some of the turmoil they've seen, but there are people who, if you've got knowledge, local knowledge, some of these markets can really be quite exciting. They're extremely high risk. They have high potential return, but they do provide really good diversification. So what I want to do, I'm going to stop the class here and let you think through this. See if you can go back and write out the entire BUCS. Remember, when you write out BUCS, it's not just beta, capitalization, style, and U.S. versus non-U.S. You need to define what I mean by beta. You need to define what I mean by capitalization. You need to talk about the subclasses. So for beta, you got cyclical and non-cyclical. For capitalization, you have large cap, mid cap, and small cap. Also micro and penny stocks. Style, you have growth and you have value. U.S., you have global stocks that you break into U.S., international. International, you need to break into developed. emerging, and frontier. And then you got the strategy for each one of these. For the strategy for non-U.S. stocks, we'll talk a little bit more about that, but it really comes back to currencies and economies. I have to actually tell you what I think about the currencies and economies, and for emerging, it comes back to the economies. So I have to give you really specific information on that. It's a little easier tactically to know what to do, because I'll say I think the U.S. is going to grow faster than Europe. And that tells you probably want to be in U.S. stocks and avoid European developed market stocks. All right, so we'll stop it there, and we'll get more and more into non-U.S. stocks in the next session.